Here is a historical fact about the stock market that surprises most people, including many experienced investors. Over long, multi-decade periods, dividends and the reinvestment of those dividends have historically accounted for a substantial portion of the total return of broad equity markets. In many widely cited long-run studies of the S&P 500 going back nearly a century, dividends and their reinvestment have contributed somewhere in the range of 30% to 40% of the total cumulative return, with the remainder coming from price appreciation alone. This means that an investor who held the broad market for decades but never reinvested a single dividend, taking every payment as cash and spending it, would have ended up with dramatically less wealth than an investor who held the identical underlying investment and simply reinvested every dividend payment back into more shares automatically the entire time. Same stocks, same price appreciation, same starting investment. A meaningfully different outcome purely as a function of one mechanical decision repeated automatically, year after year, for decades. This video explains exactly how dividend investing works, the one specific mechanical fact about dividends that almost every beginner misunderstands, the actual mathematics of dividend reinvestment compounding over time, how dividends are taxed for Canadian investors specifically, and, just as importantly, the genuine limitations and risks of building a strategy too heavily around dividends specifically, rather than total return more broadly. A dividend is a portion of a company's profit distributed directly to shareholders, typically paid quarterly, sometimes monthly or annually, depending on the company's specific payment schedule. When a company generates profit, its leadership decides how to allocate it, reinvesting it back into the business, research, expansion, acquisitions, paying down debt, buying back shares, or distributing a portion directly to shareholders as a dividend. Companies with stable, predictable cash flows and limited need for heavy reinvestment, banks, utilities, telecommunications, established consumer goods companies, have historically been more likely to pay substantial, consistent dividends than younger, rapidly growing companies that typically prioritize reinvesting all available profit into continued growth. Here is the vault from the opening. The mechanical fact almost every beginner misunderstands. When a company pays a dividend, its share price mechanically decreases by approximately the amount of the dividend paid on the payment date. This is not a market reaction, a coincidence, or a sign of weakness. It is a direct, mechanical consequence of how dividends work. If a company is worth $100 per share and distributes $1 per share in cash to shareholders, the company itself, its cash reserves, and therefore its underlying value, is now worth $1 per share less than it was before the payment, because that dollar has physically left the company and landed in the shareholder's account instead. The share price adjusts down by approximately that amount on what is called the ex-dividend date to reflect this. Why this matters so much for understanding dividends correctly. This means a dividend payment is not, by itself, a source of new wealth created from nothing. It is a transfer of value from one form, share price, an unrealized paper value, to another, cash in your account, a realized value, with the same total combined value before and immediately after the payment, all else being equal. This is precisely why describing dividends as free money is a mechanical misunderstanding. The money was already yours, embedded in your share value, before it was paid out as cash. So why does dividend investing matter at all, if it is simply moving value from one column to another? 3 genuine, distinct reasons covered across the rest of this video. First, receiving cash dividends provides a tangible, spendable income stream without requiring you to sell any shares, which matters enormously for retirees or anyone seeking income without depleting their underlying holdings, covered in Segment 2. Second, dividend-paying companies, as a category, have historically demonstrated certain favorable characteristics, covered in Segment 4, related to financial discipline and stability, distinct from the cash payment mechanism itself. Third, and most powerfully, covered in Segment 3, reinvesting dividends rather than spending them creates a specific automatic compounding mechanism that meaningfully accelerates long-term wealth accumulation, which is the actual source of the power referenced in this video's title. Your action step. The next time you see a stock or ETF's price drop by roughly the amount of its dividend on a payment date, recognize this as the expected mechanical consequence of the payment, not a sign that something has gone wrong with the investment. The first genuine, distinct value of dividend investing, separate from the reinvestment mechanism covered in Segment 3, is the ability to generate spendable income without having to sell any of your underlying shares. Why this distinction matters so much, particularly in retirement or any income-dependent phase of life. An investor relying purely on a non-dividend-paying growth portfolio for income must periodically sell shares to generate cash, regardless of what the market is doing at that specific moment. This creates a specific, well-documented risk in retirement planning called sequence of returns risk. If a significant market downturn occurs early in a withdrawal period, an investor forced to sell shares at depressed prices to generate needed income locks in losses, and permanently reduces the number of shares remaining to benefit from the eventual market recovery, a risk that compounds over the remaining years of the withdrawal period. A dividend-paying portfolio, by contrast, generates cash income through the dividend payment itself, without requiring any shares to be sold at all, meaning that even during a market downturn, an income-focused dividend investor continues receiving cash distributions, assuming the underlying companies maintain their dividend payments through the downturn, which is not guaranteed, a risk covered in Segment 4, without being forced to sell shares at a depressed price to generate that same income. The psychological benefit, distinct from the purely mathematical one. Many investors, particularly those without extensive investing experience, find it considerably easier to remain calm and avoid panic selling during a market downturn when they are still receiving regular, tangible cash payments from their portfolio, compared to an investor who must watch a pure growth portfolio's total value decline with no offsetting cash distribution to provide a sense of ongoing return. This is a genuine behavioral advantage, even though it does not change the underlying mathematics of total return. The Canadian-specific application. Canadian dividend-focused ETFs, such as VDY, covered extensively in this channel's other videos, concentrate in sectors, Canadian banks, energy, telecommunications, and utilities, historically associated with consistent, long-standing dividend payment histories, including maintained or only modestly reduced payments through several historical economic downturns, though, again, this is a historical tendency, not a guarantee, covered fully in Segment 4. The important nuance: this benefit applies specifically to the withdrawal phase, not the accumulation phase. For an investor still in the accumulation phase of their investing life, not yet drawing income, still adding to their portfolio, the sequence of returns benefit described above is largely irrelevant, because no shares need to be sold during a downturn, regardless of whether the portfolio is dividend-focused or pure growth. This specific advantage of dividend investing becomes meaningfully relevant primarily during retirement or any other phase where an investor is actively drawing income from their portfolio rather than continuing to add to it. Your action step. If you are still in the accumulation phase of your investing life, recognize that this particular benefit of dividend investing is less immediately relevant to your current situation than the reinvestment mechanism covered next in Segment 3, and plan your portfolio composition accordingly, potentially shifting toward a more dividend-focused allocation as you approach the specific phase of life where this income benefit becomes most valuable. This segment covers the actual source of the power referenced in this video's title. The Dividend Reinvestment Plan, commonly abbreviated DRIP, an automated mechanism offered by most Canadian brokerages that automatically uses every dividend payment received to purchase additional shares or fractional shares of the same investment, rather than depositing the dividend as uninvested cash in your account. Why DRIP creates such a dramatic compounding effect over long time horizons? Each dividend payment, reinvested, purchases additional shares. Those additional shares then generate their own dividend payments in future periods, which themselves get reinvested into still more shares, which generate further dividends. An accelerating, self-reinforcing cycle that, combined with the underlying price appreciation of the investment itself, produces a meaningfully larger total return than the price appreciation alone would produce on its own. A specific illustrative calculation using standard conservative long-run assumptions. Assume an initial investment of $10,000 in a diversified dividend-paying equity portfolio with an average dividend yield of 3% and average annual price appreciation of 6%, held for 30 years. These are standard, conservative, illustrative assumptions, not a guarantee or prediction of any specific fund's actual future performance. Scenario A. Dividends taken as cash, not reinvested. The investment grows through price appreciation alone at 6% annually. $10,000 becomes approximately $57,000 after 30 years. Additionally, the investor has received a separate stream of dividend cash payments along the way, which, if spent rather than invested elsewhere, do not contribute to the compounding of the original investment itself. Scenario B. Dividends reinvested through DRIP. The investment now compounds at an effective combined rate closer to 9% annually. 3% dividend yield plus 6% price appreciation, both compounding together. $10,000 becomes approximately $132,000 after 30 years. The difference, approximately $75,000, more than double the outcome from the identical starting investment, identical underlying price appreciation, and identical dividend yield, purely as a function of one mechanical choice: reinvesting rather than spending the dividend payments. Why this matters more the longer the time horizon extends. This compounding effect, consistent with the broader compound interest mathematics covered extensively elsewhere on this channel, becomes dramatically more pronounced the longer the holding period extends, because each additional year provides another cycle of dividends generating further shares, generating further dividends. The difference between reinvesting and spending dividends over a 5-year period is meaningfully smaller, in both absolute and proportional terms, than the difference over a 30-year period. The Canadian practical application. Most major Canadian discount brokerages, including Questrade and Wealthsimple, offer automatic DRIP enrollment for eligible dividend-paying stocks and ETFs at no additional cost, meaning enabling this mechanism requires a single, one-time setup decision rather than any ongoing active management. For a Canadian investor pursuing a dividend-focused strategy, particularly during the accumulation phase of their investing life, as distinguished in Segment 2, enabling DRIP is one of the highest leverage, lowest effort decisions available. The Canadian dividend tax advantage. As covered in this channel's dedicated dividend taxation video, eligible Canadian dividends, paid by Canadian public corporations, receive favorable tax treatment relative to ordinary income through a mechanism called the dividend tax credit, which is designed specifically to avoid double taxing corporate profit that has already been taxed once at the corporate level before being distributed to shareholders. At many common Canadian income levels, the effective tax rate on eligible Canadian dividends received outside a registered account is meaningfully lower than the effective tax rate on an equivalent amount of regular employment income or interest income. Though the exact effective rate depends on your specific province and total income level, and you should verify current figures using official CRA resources or a tax calculator for your specific situation, since these rates are periodically adjusted. The TFSA consideration. Inside a TFSA specifically, this entire tax credit discussion becomes irrelevant in the most favorable possible way. Because dividends received inside a TFSA are not taxed at all, regardless of the dividend tax credit mechanism, making the TFSA frequently the most tax-efficient account in which to hold Canadian dividend-paying investments, as covered fully in this channel's TFSA-focused videos. Now, the genuine, honest limitations and risks of dividend-focused investing, because a complete picture requires this section. Risk 1. Dividends are not guaranteed and can be reduced or eliminated. Unlike a bond's contractual interest payment, a dividend is a discretionary decision made by a company's board of directors, and it can be reduced or eliminated entirely during periods of financial difficulty. Historical examples across many industries and economic downturns demonstrate that even long-standing, seemingly reliable dividend payers can and sometimes do cut or suspend payments when circumstances require it. Any dividend investing strategy that assumes payments are guaranteed is building on an inaccurate premise. Risk 2. Sector concentration. Dividend-focused investment strategies, almost by their nature, concentrate disproportionately in specific sectors: financials, energy, utilities, telecommunications, that historically pay higher dividends, while underweighting sectors, particularly technology and other high-growth industries, that historically reinvest most profit rather than distributing it. This concentration means a dividend-focused portfolio's performance becomes more tied to the specific fortunes of these particular sectors than a broadly diversified total market portfolio would be, which can be either an advantage or a disadvantage depending on how those specific sectors perform relative to the broader market over any given period. Risk 3. Yield chasing can lead to lower quality, higher risk investments. A company offering an unusually high dividend yield relative to its peers or its own historical average is frequently signaling financial distress rather than unusual generosity, because a dividend yield is mathematically a function of dividend payment divided by share price, and a declining share price, often reflecting investor concern about the underlying business, mechanically produces a rising yield, even if the dividend payment itself has not changed. Inexperienced dividend investors sometimes mistake an unusually high yield for an unusually good opportunity, when it frequently signals the opposite. A risk sometimes referred to as a dividend trap or value trap. Risk 4. Total return, not dividend yield alone, is what ultimately matters. A focus on dividend yield specifically, to the exclusion of total return, price appreciation plus dividends combined, can lead an investor to overlook genuinely superior total return opportunities simply because they pay a lower current dividend yield, even when their combined total return, including any reinvested growth, would have been superior over the same period. The mathematics in Segment 3 work in dividend investing's favor specifically when the combined total return is strong. Not because dividends are inherently superior to price appreciation as a category of return. Your action step, if you are building a dividend-focused strategy, explicitly evaluate the total return, price appreciation plus dividends, of your specific holdings against a broad, diversified benchmark over multi-year periods, rather than evaluating dividend yield in isolation, and remain aware that any individual company's dividend, however historically consistent, is not contractually guaranteed. Let's come back to where we started. Over long multi-decade periods, dividends and their reinvestment have historically contributed somewhere in the range of 30% to 40% of the total cumulative return of broad equity markets. You now understand exactly why that statistic is true and precisely what mechanism produces it. A dividend, mechanically, is not free money. It is a transfer of value from share price into cash, with the same total value immediately before and after the payment. But what an investor chooses to do with that cash payment, spend it, or reinvest it automatically through DRIP, creates a meaningfully different long-term outcome, because reinvested dividends purchase additional shares, which generate their own future dividends in a compounding cycle that, combined with underlying price appreciation, has historically produced a substantial share of the stock market's total long-run return. Beyond this reinvestment mechanism, dividend investing offers a genuine, distinct benefit during the income-drawing phase of life, generating spendable cash without forcing share sales during market downturns. And Canadian investors specifically benefit from the dividend tax credit on eligible dividends, or complete tax-free treatment, when held inside a TFSA. But the genuine, honest risks deserve equal weight. Dividends are not guaranteed. Dividend-focused strategies concentrate in specific sectors. Unusually high yields frequently signal trouble rather than opportunity. And total return, not yield in isolation, is what ultimately determines whether any specific dividend strategy was actually the right choice in hindsight. Dividend investing is not inherently superior to broad market index investing, and it is not inherently inferior. It is one legitimate, historically effective approach, with a specific, well-understood mechanism behind its power, and understanding that mechanism precisely, rather than treating dividends as a vague sign of quality or free income, is what allows you to use this strategy well.